Thank you for tuning in to another edition of the Vulcan Report. It's been a few days since we have done a Vulcan Report, and I just wanted to let you know that quite a few things have taken effect since our last video. Well, you notice we have been in a very nasty corrective move that has now led to a new trend, a game changer in the market. Hence the little red bear at the bottom right hand corner of the screen. Also, you'll notice here, bearish, bear market. We are officially in a bear market in the major U.S. stock indices. Now, as you know, we try to keep it real as much as possible in these YouTube videos and as well as in the Black Ops trading room. I don't just talk to you about successes, I talk to you about failures, and I keep it real. One thing I'm going to disclose to you in this video is basically how I've been doing personally, how we've been doing it in the Black Ops trading room. And the purpose and the reason of that is so that you can know and what to expect and what it's really like to make a living trading in the financial markets. I mean, it's a lot of people, they like to talk to you about all the wins and the good calls and the good trades, but they don't tell you about losing trades or extended periods of drawdown or failures. They don't talk about that because they want to sell books and tapes and widgets and thingamajigs and thingamabobs, and they want you to come and spend thousands of dollars on their courses and materials and blah blah blah. That is not my purpose. My purpose, my original purpose and continued purpose, is to help as many people as possible learn the truth about Wall Street and how it works, and to also expose some of the fallacies about Wall Street and misconceptions, things of that nature. Now, it is true that you can make a very good living trading the markets. However, it is not easy, even though sometimes pundits on television can make it look easy and make it sound easy. Don't get me wrong, I believe that the stock market has produced more millionaires and billionaires than any other industry, even greater than real estate. I think real estate is second, a close second. But the markets, when I say markets, I mean equities, I mean commodities, futures, and Forex, okay, and bonds. That's I'm talking about financial instruments. The thing that we have before us, that we have been diligently attempting to adapt and change and overcome to, is the never-ending changing market conditions. Over the past few years, we've had new government regulatory and oversight and failure and lack thereof as well. We've also had a lot of global, macro, and microeconomic uncertainties and situations that have made the markets more chaotic and more random also. A lot of people like to blame high-frequency trading as the cause of all of our financial woes. But the truth of the matter is these high-frequency algorithms have very little or nothing to do with it. Sure, large size and volume can move markets temporarily, but it is not the main cause or effect, okay? If that were the case, then how do you explain market crashes like 1929 and the ones that happened in the 1800s? Anything prior to 1987, how do you explain it? We didn't really start having the black box algorithms start to really take place until the 1987 crash. And even then, they were not responsible for the crash. The truth of the matter is that people decided they wanted to sell. You can't blame the computer for that. Man has to blame himself. Remember, people, man is the one who creates the computer. All the computer is designed to do is to execute your trading for you. Even if you can execute a trade at a billionth of a fraction of a second, it still is no matter. And the truth of the matter is, it still doesn't gain them a huge advantage in the markets, to be quite honest with you. A lot of them blow up and lose a lot of money also. All right, if that was the the be all and end all, then every single human being on the face of the planet would be operating that way. There's still a lot of old school guys out there who aren't using that, and some of them don't even really use a computer. Okay, you got guys out there still doing charts and stuff by hand. All right. The market is made up of individuals and millions of individuals, and each individual has their own ideas and concepts and rationale for why they buy or sell, and when they buy and sell, and how much they buy and sell. And there are a lot of forces that can contribute to that. So it's really no one's fault that markets go up or go down. It's part of the nature of the market. It's built up on sentiment, what people think, what people believe. And that's what it is, okay? So markets bubble and they burst. They bubble and they burst. You have bull markets, you have bear markets. You have sideways consolidated congestion markets that can do that for an extended period of time. Case in point, look at here. Look how we just moved sideways right here. All right? Even though this is a daily chart, it can easily be a weekly chart. It can be a monthly chart. If it was, this would be 1, 2, 3, 4, 5, almost a year's worth of consolidation, just moving sideways. Markets can do that. Doesn't matter the name of the market. The chart patterns are the same. All right. Markets go up because people are buying it. That means that particular security is in demand. Markets go down because the security is no longer in demand. People are looking to liquidate their long positions, and then you have people that want to start selling short. And so that creates the cascading downward effect. The hardest part in trading is the trend following aspect. You want to get in as early as possible when the trend is just starting and developing, but sometimes that's a little bit harder to do. Also, the psychological aspect comes into play. I don't care how long you've been doing this. I don't care how good you think you are. You will have losing periods. You will have drawdown periods. You will miss the boat at times. There's so many factors that come into play. And it's just how it is. The greatest and the best have had losing trades. You will have that. The tenacity to hang in there when things are going wrong is what separates the successful market participants from the ones that are just fly by night and come and go. There's an old saying, those that can do and those that can't teach. All right. Now, I'm not here to step on anyone's toes. I don't have a problem with people who charge a lot of money to say, I got a secret, here, pay me this money and then you can have it. Okay. I don't have a problem with people enterprising. And there are a lot of valuable methods. There's no one way to make money in the markets. There's so many different systems and algorithms and ideas and concepts and principles that have been around for, some of them have been around for hundreds of years, if not thousands. It's just so many different ways to make money. Okay, bears make money, bulls make money, but what? Pigs get slaughtered. Okay. So anyway, enough of that rambling on. I want to get to some analysis here. But also want to be upfront. For the past, I want to say past 2 months, I have been in a extended drawdown period. Not much based on historical standards and compared to other mutual funds, hedge funds, and money managers, because I have very tight risk controls and parameters when I'm executing and doing things. But nevertheless, my timing's been off a little bit. All right. Mainly because I've been in the lab a lot. I've had to go in, and I've had to do a lot of adjustments in the algorithms based on a lot of information that's been coming in that was letting me know that we're in for something that is unprecedented and that we had never seen before. That's why when I was on the Wide Awake radio program, I warned everyone that within the next 8 days, and this was before, the infamous debt ceiling situation by August the 2nd. 8 days prior to that, actually make it 12 days prior to that, I warned that the markets were looking like we had topped out, and that this wave of selling was going to start the beginning of a very nasty bear market, and that we would take out the 2009 lows, not just test them, but take them out. And now, even though I had that information and that knowledge, I still had to do a lot of homework and number crunching to determine, is that really correct? And is my timing really, is what I'm seeing as far as the time frame really true? You know, sometimes you do second guess yourself. And I'll be honest with you, I consider myself a patriot. You know, I don't like to believe a lot of the stuff that I tell you guys, report, and even put on my blog. I don't want to believe that. You know, I'm not stupid. I look at the reality. You know, it's the saying that you prepare for the worst, but you hope for the best, so to speak. So during this period here, I was still looking at this as buying opportunities when we were up in here. Even when we got down to here, okay, I got caught with the first breakdown here. I got caught long with the first breakdown up in here because I was holding long positions. Looking at this pullback as a buying opportunity. So instead of betting against America and against the economy and against all these things, I was hoping that some kind of way they would, pull a rabbit out of the hat, whether it be quantitative easing or something, even though I had information that said that wasn't going to happen. And I was just hoping for the best, that, because we've been here before. This was a new all-time high in the NASDAQ, and we would come back. But that just did not happen. And the market's disappointed, and we just crashed. I mean, look at this. We just crashed. We came from this high up here all the way down to here. All right? So even though you want to hang in there with the U.S. and have faith in the U.S. government and politicians to do the right thing and to curb spending and bring the deficit under control, unfortunately, as you can see, that's just wishful thinking. And sometimes you just have to go with your gut. And even though it's telling you that all hell is about to break loose and it's over, the game is over, and you don't really want to believe it, and you still hang in there, and you still, say, let me do some value investing and put money into, sound companies with sound fundamentals and strong balance books, that's not enough. If you bought Apple here on July the 20th, you had to set through more than a $75 correction, okay? That's nasty. That's huge. But you're saying, hey, they have better earnings and great guidance going forward. And then, bloop, here we go. So sometimes, even though you want to believe that we're going to get out of this and that our politicians will finally figure it out and blah, 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 again, that's putting a lot of faith in man and putting a lot of faith in people who have not gotten it right for a very long time. They've been wrong on everything, When they asked Tim Geithner and Ben Bernanke if we were going to be in a recession or if certain things would happen, they said, no, absolutely not, and they happened right after they said that. So you can't always trust what you see. But anyway, this is the Nikkei chart here. And as you can see, we had a nice run up yesterday. Basically a dead cat bounce, people taking profit off the short positions. In order for this to have been real, we would have needed to close above the prior candle's high, and we did not. Even in the after hours market, again, we did not. And now, as I'm doing this video, the markets are coming down. The Nikkei now is at 89.80, and we closed yesterday at this 91.80 level. Okay, so we're coming off now. I expect that we will take out these lows here and head lower and start to see the next support level probably around this 83 level. Okay, basically what you're seeing is this: the longer we trade within this high and this low the next couple of days forward, the more pressure and power is going to build up to the next leg down. So basically, from here, July the 26th to yesterday, you can expect this range, next leg down, to be twice as long on the way down. So if the Dow lost 1,200 points, the next leg should be at least another 2,000 points to the downside. Okay? There you have it. That's the big and nasty of it. And, what can I say? Just remember to take what you can and give nothing back. And right now the market's bearish, so you stay short.